In recent American politics, few industries have invested as much money with as significant an impact as the cryptocurrency sector did during the last election cycle. Cryptocurrencies like Bitcoin are digital assets maintained by decentralized computer networks. To some, these virtual currencies are confusing, while to others, they are captivating. They serve as both a means of conducting transactions and as high-risk, high-reward investments. At least 17 million Americans currently hold some form of cryptocurrency, making the debate over how the industry should be regulated a pressing issue. With a crucial piece of legislation pending before Congress, it is no surprise that major crypto companies ranked among the top donors during the past election. Since then, the value of Bitcoin has reached record highs. It remains uncertain whether the cryptocurrency industry will persuade Congress or the incoming Trump administration to establish the regulatory framework and legitimacy they desire. However, these companies have made substantial financial contributions to advance their cause. A notable example occurred during the final months of a closely contested Senate race in Ohio. Republican candidate Bernie Moreno received $40 million worth of positive advertising from a political action committee PAC called Defend American Jobs. Although these ads did not explicitly mention cryptocurrency, they were funded by crypto companies and played a significant role in helping Moreno defeat Democrat Sherrod Brown. This outcome was particularly disappointing for Brown, the chairman of the Senate Banking Committee and a vocal critic of cryptocurrency. In a tight race, substantial financial support can make a crucial difference. Brad Garlinghouse, CEO of Ripple, a company behind the cryptocurrency XBRP, has been a prominent figure in crypto's political involvement. Ripple, along with two other companies, contributed $144 million to PACs supporting pro-crypto candidates from both parties. Their influence was felt in key races, such as the successful campaigns of Democratic senators in Michigan and Arizona. Overall, crypto companies accounted for 1/3 of all direct corporate contributions to super PACs. Of the 29 Republicans and 33 Democrats the industry supported in congressional races, 85% were victorious. This election cycle was undoubtedly a major win for the cryptocurrency industry. However, critics argue that the industry effectively bought the election. Garlinghouse counters this narrative, stating that their efforts aimed to educate voters, much like other industries do, and that financial backing merely amplified the candidates' messages. The industry's influence extended to the presidential level as well. Former President Donald Trump, who once dismissed Bitcoin as a scam in 2021, has since embraced cryptocurrency. 3 weeks before the election, Trump announced a new digital coin in which he holds a financial interest, further signaling his alignment with the industry. This move raises concerns about potential conflicts of interest. Nevertheless, the electorate supported Trump, indicating a broader acceptance of his stance on cryptocurrency. Trump's cabinet selections also reflect a favorable view of the crypto sector. His choice for Treasury Secretary, Scott Bessent, described cryptocurrency as about freedom and asserted that the crypto economy is here to stay. Furthermore, Trump's appointment of Paul Atkins, a former SEC commissioner known for consulting with crypto firms, as head of the Securities and Exchange Commission (SEC) suggests a regulatory shift. This contrasts sharply with the approach of Biden-era SEC Chair Gary Gensler, who filed over 120 lawsuits against crypto companies in a single year. The SEC's aggressive enforcement was a primary reason why Ripple and other companies established the industry's largest PAC, Fairshake. Garlinghouse characterizes this as a defensive measure against what he describes as a war on crypto. Without Gensler's leadership, Garlinghouse suggests, Fairshake might never have been formed. In response to allegations of excessive influence, the SEC maintains that the money spent by the crypto industry on legal defenses and lobbying pales in comparison to the billions lost by crypto investors due to fraud and corporate failures. Former SEC official John Reed Stark echoes this sentiment, warning that cryptocurrencies pose substantial risks. He argues that crypto lacks transparency, financial disclosures, and adequate regulatory oversight, creating systemic dangers not only for investors but for society as a whole. Stark highlights concerns that cryptocurrencies facilitate criminal activities such as ransomware, human trafficking, sanctions evasion, and money laundering. One high-profile example of crypto-related misconduct involves Sam Bankman-Fried, the founder of FTX, a major cryptocurrency exchange. Bankman-Fried's conviction for fraud and the subsequent collapse of FTX in 2022 jeopardized $8 billion in customer assets, much of which fell outside the jurisdiction of U.S. regulators. Garlinghouse insists that this case represents an outlier and that the industry also includes many responsible actors. Ripple itself employs 900 people and collaborates with regulated financial institutions to facilitate faster and cheaper international money transfers using XBRP. The SEC's 2020 lawsuit against Ripple alleged that the company's sales of XBRP constituted unregistered securities offerings. Ripple has since spent over $150 million contesting these claims, arguing that existing securities laws do not apply to modern digital assets. Garlinghouse advocates for new, clear regulations tailored to the cryptocurrency industry. To advance this agenda, Ripple and other crypto firms have channeled significant resources into shaping public policy. This effort contributed to the passage of the FIT21 bill in the House of Representatives, which seeks to establish a new regulatory framework for digital assets. While the SEC would retain some oversight, the legislation shifts primary responsibility to the Commodity Futures Trading Commission (CFTC), which has a more permissive regulatory approach. Supporters of the bill argue that clear regulations will prevent companies from moving offshore and promote innovation in the U.S. Critics, however, caution that the CFTC's limited resources and investor protection mandate could leave consumers vulnerable. Despite these concerns, bipartisan consensus exists on the need for updated cryptocurrency regulations. The debate over cryptocurrency regulation highlights broader questions about the balance between fostering technological innovation and protecting consumers. As the industry continues to grow, its political influence is likely to remain a powerful force shaping the future of U.S. financial policy.